The broadcast is now starting. All attendees are in listen-only mode.
All right, everybody, welcome to today's webinar. This is Jacob Locke, Director of Marketing here at One Resource Group. Appreciate you all hopping on. I know you're all plenty busy, but I can attest that this next 35 minutes will be well worth your time. As the title shows, we'll be going over how you can learn how to maximize early cash values using COIL and Equitable. We have our good friend and partner, John Price, over at Equitable. He's going to do a great job showing you exactly how to do so. With that being said, housekeeping item will be, we'll save the questions for the end of the webinar. Feel free to send them in throughout and we'll address them towards the end. But with that being said, John, take it away, man.
Jacob, I appreciate it. Thank you, everybody, for taking the time to be present here with me and your folks at One Resource Group. Truly honored and flattered anytime a financial advisor or an insurance professional takes time out of their day when they're prospecting, meeting with clients, designing solutions, when they take time away from that to kind of hear an idea and listen to what I have to say. Honestly, it's a flattering experience. So appreciate the time. Like Jacob said, my name is John Price. I'm the Regional Vice President for kind of the Midwest area at Equitable. Been with Equitable for close to 10 years now, and have been working as an insurance consultant, wholesaler, kind of insurance guru, if you will, for the last 19 years of my career. Did start out as a financial advisor for the first couple of years, so I have sat in your seat before, although it's been a long time ago. I will not say that I'm nearly an expert in that capacity. That's what you specialize in. But if we have the opportunity to maybe kind of help educate from a consultative manner what it is we're doing here at Equitable to help successful financial advisors implement an asset location strategy with their clients, we'll take it by the horns and do whatever we can to kind of position you in the best light. With that said, maybe just to kind of preface what we're going to be going over through today, we will talk a little bit about product and platform and maybe why we specialize in this marketplace. What might be a little bit different is the time we're going to spend together is really going to be talking about asset location and talking about the idea of helping clients who maybe have a portfolio, who have retirement goals, who have insurance needs, and kind of wrapping that all into how can we best position properly structured life insurance to add yield to their portfolio and to financially benefit themselves in retirement and kids, loved ones, and charities when they do pass on their wealth. So let's go ahead and kick it off. I do want to maybe talk about the growth history over the last 4 years. Everyone, well, you may not know, Equitable/AXA, which was our name, 4 years ago for the previous 20. We've been in the business for 170 years. But the last 4 years has been a major pivot and focus in what we want to do and specialize in, and offering accumulation-based life insurance products, right? Of course, we've got term insurance and we do have an IUL contract, but a majority of what we're doing and pivoting towards and specializing in is variable life insurance products with an accumulation focus or, a guaranteed death benefit focus. And to be a true believer in variable life insurance is important in my view, especially when it comes to clients owning a separate account product, something that doesn't require, the insurance company per se to provide you with a rate of return or the client with a rate of return, yet more of the, hey, I can kind of control my own destiny. I can have a cost-effective shell or a product, and then, really kind of guide myself through a successful insurance program. Since we've pivoted towards the accumulation focused life insurance concepts, we were doing about $89 million worth of variable life to last year, finished up at $210 million. CES, which is the company that we own, that's part of our organization, that handles all of the administration and the case design of our COIL product, which we call COIL. Now, we didn't just misspell COIL, it actually stands for Corporate Owned Incentive Life. But CES is kind of our COIL world, has grown from just over $36 million of new premium every year, or weighted target premium, to over 104. We're going to do 130 this year. We're already projected to do. So this is an explosive growing business line for us. And the more we do, the better at it we get. Our independent third-party business has over doubled, almost close to tripled as well. So if you're hearing our name when you're talking to other producers or One Resource Group or really anyone in the industry, it's largely due to our focus with this product and platform we're going to talk about today. If you think of the kind of the pillars of how we come to market and focusing that growth, it's kind of through three things: accumulate, manage, and distribute. Just recently, we can add one more to that, and it's more the idea of accumulate, manage, distribute, and protect. And when I say protect, we're going to talk briefly here in a couple of more minutes about our structured index options inside of our variable life insurance contract. So if anyone's used to or selling RILA annuities, you know exactly what I'm talking about when you hear structured index option. We do have 5 different unique sleeves inside of our already existing variable life insurance policies. So really this product and what we're doing is kind of a go anywhere. You can make this look like an IUL. You could make it look like a fixed UL. You could make it look like the most aggressively invested VUL you've ever seen. So it's really kind of taking the ownership upon yourself and the client to kind of create what you want out of these products and platforms. These slides are largely, I'm having trouble getting these to kind of, there we go. Now we're clicking. Let's kind of shift right to the meat of this and talk about tax and asset location strategy. And I'd like you to maybe just sit there and for a second imagine you're sitting in front of a client and you could say, hey, for a moment, imagine that the IRS changed the rules, allowing your clients the chance to invest in a Roth IRA without any contribution limits or contribution maximums or earned income limits. Number one, would your client be interested, right? More than likely, if they're high income, they would say, heck yeah, I'm interested. Number two, how much would you actually invest or would you dedicate towards that Roth-like strategy if there were no rules or limitations? So obviously it's highly unlikely that the government's going to make any changes to allowing more and more people to do a Roth IRA because of how advantageous they are to clients. But what we've done at CES and at Equitable is engineered a tax and accumulation strategy that can alleviate the challenges facing those high net worth and high income individuals, and not having pre-59.5 withdrawal penalties, not having RMDs at age 72, not having phase out provisions, and having a product that is fully liquid, no surrender charge, can be personally owned, and looks a lot like the stuff that Fortune 500 companies buy of their executives as part of a deferred comp plan. We're taking that institutionally priced type of insurance contract and bringing it right to individuals. I'll briefly stop here. I don't want that point to go unnoticed. There are 13 insurance companies in this business, in the entire industry, quite frankly, that have a COIL contract or an institutionally priced insurance policy for accumulation. There's 2 of them that will allow it to be personally owned. It's us and another company that starts with an N. I believe it is Nationwide. Only one of us, which would be us, allow that to be personally owned, and it does not require any company ownership, any company sponsorship, doesn't have to be company dollars. We're just allowing rich people, high income individuals, access to a product that they've never had access to before and not have it associated with a company. So how do we build and position the idea of someone even wanting or utilizing what we're about to talk about and offer? Well, we first have to kind of start at the asset location versus asset allocation strategy. If anyone has been in the business long enough and remembers, maybe back in the 80s when mutual funds became super popular, before there were financial advisors, there were stockbrokers, and they picked a basket of stocks, and maybe they said, hey, they're trading blue chip stocks and helping clients earn money. And mutual funds had the bright idea of, well, if we analyze things differently and we can minimize risk and maximize returns through building a portfolio that's diversified, talking about the efficient frontier and risk tolerance questionnaires and things like that, we can increase a client's yield and lower the risk in the policy by doing an asset allocation profile. We got some large, small, mid, emerging markets, international bonds. We mix all these up based on what your risk tolerance is. And it helped them sell mutual funds, right? Because mutual funds were a basket of stocks, not just individuals. We're doing the exact same thing with accumulation life insurance inside of these investment portfolios by talking about asset location, right? Money can be in 3 buckets, right? And I just want to skip ahead. 1 second. Ordinary income bucket, capital gains bucket, tax-free bucket. The ordinary income bucket is by far and away the largest asset that clients typically own today. Think 401k, 403b, IRA, something that was tax deductible to put the money in. It's growing tax deferred, but when they go to access it, it's going to be earned income and will pay taxes at ordinary income rates. And we don't know exactly what that's going to be. This is always kind of the big, the life insurance guy is trying to tell you, yeah, well, taxes are going to go up. So you got to get some of this tax-free stuff. I don't know if taxes are going to go up. I can tell you they're not going to be the same. I mean, the tax code has changed on average over the last 90 years about every 4.5 years. There's some adjustment to ordinary income taxes. Heck, the highest marginal income tax bracket, just 40, 50 years ago, it's like 79%. So I can tell you we are historically low, just bounced off the low a couple of years back, but there's probably room for them to go up. But even if taxes are the same in the future as they are right now, using asset location to kind of get more of that tax-free Roth IRA looking stuff is still going to be meaningful, important, and beneficial to clients. When we think about that third bucket, the capital gains bucket, right? There was a time, not too long ago, probably the late 80s, where capital gains and ordinary taxes and ordinary income, they were the same rate. So there used to only be 2 buckets, for crying out loud. But at least there's a little bit of an advantage for clients to kind of have short and long-term capital gains as part of their overall strategy as well. We're not saying own all tax-free bucket stuff, which is life insurance, muni bonds, and Roth IRAs. But having at least a 30-year portfolio in that kind of makes that magic blend for tax purposes. So let's kind of see this stuff in action. Let's look at a properly structured asset location plan. On the left, every insurance company's either got the Joneses, the Smiths, or the Johnsons, whatever, but we use the Smiths. So we've got the Smiths who are looking for $350,000 of income in retirement, 20 years down the road. And all they have to really live on is they're pumping money into their 401k and they're getting their match and they're doing everything from a ordinary income bucket in retirement kind of strategy. So if they need 350, if we apply today's marginal tax rates to it, the first 23 is at 10 and then 71 at 12 and then 106 at 22, so on and so forth. Their effective tax yield is about 20%. So $350, then they're going to pay $70 in taxes, net $280, roughly. Well, if they had a properly structured 3-bucket strategy, they had some of the capital gain stuff, they had some of the tax-free, properly structured life insurance assets, and then they also had their 401k or IRA. What we would suggest is, well, let's take the first 150 out of the ordinary income bucket. All right, then we're kind of dialing in our tax bracket. We're not going to pay any higher than 22% on any of that money. In fact, a majority of that's going to be under, right? That 71 and that 23, those they're paying less in taxes. And take the next 100 grand that they need out of their capital gains, investment bucket. Well, because up until that point in time, we only have 150 ordinary income. That 100,000 is still at 15% capital gains. It hadn't hit the 20% threshold just yet. So we pay 15 on that. And then we can scrape $100,000 out of our properly structured life insurance plan. Effectively, what we've done is decrease the effective tax yield, cut it in half, down to 11%, $31,000. So if we have this properly structured idea where we've got the accumulation life insurance piece to use in retirement, we can cut taxes in retirement quite significantly. Let's look at it at some other income thresholds as well, because the smaller the amounts, the higher the impact. I don't have to walk through this entire screen, but sticking with the a third strategy, I mean, how many of your clients would be interested in having a tax bracket that's 0.5%? Right? So the first 40 grand, we're paying 1.2% effective tax yield on, and then we're paying capital gains of 0 because we're taking less ordinary income in our total 120 of need, and then 0% in the tax-free bucket. What client wouldn't be interested in, almost a 0% tax bracket? But we can do that if we properly structure things. Let's say they need 240. Well, at 240, we can effectively, in the 1/3 strategy, get the effective tax 6%. I mean, before we were talking we don't have all of these extra things. We just got a 401k to retire on. Talking about, netting 80% or paying 20% tax as well. Getting down to 3.6 will turn heads. This is the type of stuff that makes clients think this person really knows what they're talking about. This is the stuff in the future where we can really, really increase the amount of take-home money out of our retirement portfolio. And then even if we, kind of go up to 500,000 of retirement income, effective tax bracket close to 10%. So most clients are probably going to retire on 500,000 or less dollars. It is, unless inflation kind of keeps. Point being, even your high-income clients, when you can say things like, "Would you be interested in looking at some strategies and some ways to only have a 10% tax yield, or only owe 10% taxes in retirement?" I think all of them are going to say yes. So how do we build out that tax-free bucket? Here at CES and Equitable, design the life income plan. The life income plan, if you look on the right, has certain features. Right? Now, we're merchandising this and marketing this as the life income plan. Of course, there's a product in the background. But when you get an illustration from us, it's not going to be just a ledger from Equitable and the COIL contract showing you, 63 pages worth of insurance illustration, mumbo jumbo. We're going to build every one of them to have a life income plan that's an 8-page document that cuts out all of the, disclosures and presents to the client and you all the facts. The features and benefits, right? Everything's going to be accumulation focused in the plan design, right? So we're going to keep our eye on the ball, and this is going to be all about the cash accumulation. High early cash surrender values, no contribution limits, no direct surrender charges. Over 80 different mutual fund investment options, full investment discretion. We don't tell you where the client, which funds to pick out or where to go. Now, we can help with the advice. So we're not going to say, you're left all on your own if you don't want to provide that element but we're not gonna limit you. That's the point. No required minimum distributions. No tax. There's tax-free transfers and rebalancing, and distributions and death benefits, asset protection in many states. I know we've got people on here from all across the country. I do have a nice little link that can kind of dig into every state and show you how they would assess the creditor protection of life insurance cash values. But I will tell you for a fact, if you are in Ohio, Indiana, Kentucky, or Michigan, they are untouchable. So having cash value inside your life insurance contract is having a state creditor protected asset. Very powerful. We designed the underwriting to be easy to acquire the product. Anything up to $4 million in face amount and age 60, we're going to do without labs or an exam. We're going to do fluidless. The bottom line here, because of the way we're building the life income plan, we will be purchasing the minimum amount of life insurance possible. That's how we get the cash to grow as robust as possible. You'll often hear, a phrase called 7702 designed life insurance. That's kind of exactly what we're doing here. The rules and regulations in the IRS code 7702 is what lays out the rules and regulations for maximum funding a policy and how the distributions are non-reportable and tax-free. So we design one of these plans with that in mind. That way we give you all the benefits of a Roth IRA plus additional. So you may ask, what does one of these look like if we were to kind of cut through and look at a life income plan COIL ledger? So before, when we were kind of touting the no surrender charges, fully liquid strategy, this is exactly it. So let's assume we've got a 50-year-old. This is one of the Smiths, I suppose. We got a 7% rate on the hypothetical growth of the asset. We put in 100 at the end of the first year. We've got 106,481 in cash surrender value. That is if I pull the ripcord and I want my parachute, I want out, I want my money, this is what the client would get if they had hypothetically earned 7% that year. As you can tell, the cost for the policy in the first year were only like $500. This is fully liquid. This is institutionally priced. This is what we're talking about here. If we were to turn those into income distributions at age 66, we just kind of give you a sample of what that would look like. 137,832. I will tell you, not to provide too much of my personal input into these, but I don't always think it's that important to show the income on an illustration. I kind of wonder if it's the financial advisor requires it, not the client. Put it in this perspective. If you're helping a client invest for retirement, and you were like, hey, I think it'd be a good idea for, if you were to put $1,000 a month away into this brokerage account with my track record, and market returns, we could probably earn 7 or 8% rate of return, and then provide a hypothetical on what that could look like in retirement. You'd never say, well, and then if we clicked and turned it into income, it would be worth 137,832 of income until you retire. That methodology, typically only works in the insurance illustration world, but it doesn't truly work in the real world. The real world is, hey, we're going to build this tax-free asset. You're probably never going to turn on exact, annual income to the same amount every single year. You're going to pick at it. You're going to take a safe withdrawal rate out of it and some of the other assets that you do have in retirement. I'd like the methodology on thinking about this to be similar, but obviously you can run these however you like. So let me dig in a little bit to the charges, right? I keep telling you how great this thing is when it comes to, being fully liquid and charges. We can provide an annual calculation summary of all the. But here's something to look at. And here's when we compare this to outside investments. I mean, the client, money has to go somewhere, right? It either sits in a checking account, it gets invested, or it gets put, into a vehicle like this. So if we think, well, if the money's not going in here, it's going somewhere else. Well, what is the cost of taxes and management fees compared to this, which is no taxes, no management fees, but the cost of insurance? If we look at year 11, the total costs and charges were $28.40. In that year, we had a hypothetical gain of 68 grand if we look all the way on the right. Well, if you had capital gains on 68,000 of earnings in 1 year at 25%, that's 17 grand. Let's call it 20% though, because it's in today's rates. Something like 15,000. Would you rather pay 28.40 in charges in the insurance contract or 25,000 in capital gains in a brokerage account? That's why these things work, because we can make that happen in these later years. I'm going to wrap up here with a couple, about 3-4 more slides. So, Jacob, if I'm going long, I apologize. But
No, you're
obviously,
fine.
if you need to, okay, because I know you'd said earlier 30 to 35 minutes. Typically, these plans were designed, when someone was looking at one of these, and if you've ever done anything in the deferred comp space, or COIL products, it's always been, well, let's start with the 7 pay, because we know after 7 years, we can start making manipulations to the face amount and really kind of drive the best accumulated value inside the policy. What happened about 2.5, 3 years ago was the rule in the 7702 calculations changed in the tax code, where essentially you can put in way more premium versus the amount of death benefit than you used to be able to under the old codes and rulings. And it's opened up this whole new space for us, which is kind of the 3 pay. This is perfect for those clients that say, I'd love to do this strategy. I'm liquid right now because I either had an inheritance, I've got money in a brokerage account now, I had some sort of liquidity event from selling my business. I don't want to wait 7 years to make the most efficient use of this product. How quickly can I get the money in? What we will tell you on our product is the quickest and the easiest and the most efficient way to get it in is by paying it 2 years and a day, right? First premium, day 1, then day 366, and then day 1 of year 3. So it's really 2 years and 1 day. You can get all your funding done in this policy, and it's the most efficient. So if we took $1 million over time that's going into this contract, right? Remember, this is more like an investment account anyway. So it's $1 million for high income, high net worth individuals could be attainable. We do 142 over 7 years, and then we've got our internal rate of return numbers kind of down the side. If we turn it into income, $4 million on those income withdrawals. Well, if we shorten it to a 5 pay, let's get all $1 million of it in 5 years. Well, now we're getting distributions out of 4.1 million. Right? We're getting money in earlier to work longer, benefits the income distributions in retirement. Well, if we do the 3 pay or the 2 days or 2 years in a day, we can pile in another $77,000. Now we're getting even more money out in the form of distribution. We're driving additional internal rate of return earlier on in the contract. It's just kind of a winning strategy. And again, this is afforded to us because of the changes in the 7702 calculations from about 3 years ago. By the way, it's not just us. I'm not trying to tell you that we're the only ones that, get the positive benefits of those changes. All the insurance companies do. It just happens to benefit our product on short pays way more than it does some of the other carriers out in the industry. Everyone kind of wonders and thinks about maybe the Grand Slam idea. Here's our Grand Slam idea. We get quite a bit of action from advisors coming to us trying to compete maybe against some of the most wealthy individuals in their community who have talked to them about private placement insurance. If anyone knows much about, PPLI or PPVLI, it's, essentially you bring your investment and a company like Prudential or Lombard will build you the statutory insurance shell around it to hit some alternative investment tax-free return strategy. Well, we can do that and be quite competitive against the those competitors in doing so, and still leave compensation available to you as the financial advisor. On the left, you're going to see we have the ability to blend this product, this COIL contract. And it's nothing fancy. We have a term rider that can be blended in. The effect on the policy when you do blend in insurance is lower target and compensation to you, the selling advisor, and that goes directly into higher cash values for the client. So on the left, this would just be a normal, 1 million in over 3 years, very high income individual doing some alternative investing, and internal rate of return in column D, right? Still looks good over a long term, looks great. But if we blended that down to be like a 75-25% kind of blend, you're still getting a target at $250,000 on the sale. But our internal rate of return is increased by over 100 basis points in some of these examples kind of throughout the later years. With this blending strategy, I can tell you, even working, the Midwest, which, you wouldn't say is, something like you would see on the coast when it comes to high income and high net worth individuals. I've probably won 2 or 3 different private placement strategies, or beating out those companies. These rates of return will drive better cash value returns than private placement life insurance. Just kind of keep it in mind in case that grand slam opportunity does come across you. The last thing I'll mention here before we can open up to questions, I'd be happy to answer any. Didn't really get too deep on just about everything that you may be thinking. What makes us different with this whole CES and life income plan? And a large part of our competitive differentiation lies in the service platform that this policy sits on. I want you to think back of all the insurance policies that you've sold in the past. And every time you've called a carrier asking for service, whether it's change of beneficiary, ask for an in-force illustration, heck, just get a copy of the statement or any type of valuable information. You know that it could be maybe a roller coaster or a bumpy ride, getting the information that you need. All of our COIL contracts will sit on an administration platform called CESA, so CES administration. It'll have a login for you and a login for the client. When they log in or you log in, it's going to look a lot more like a brokerage account than it will, Equitable.com or Prudential.com or insert any carrier where you kind of log in and see your policies. This will have all of them listed. It'll have their values. It'll have a pie chart with their investment breakdown. It'll have return information. How much did this make last week, last month, last year? There'll be a notification center that provides premium and other as-sold illustration type of updates. The easiest example, if we design one of these things to be a level death benefit for 7 years, and then in year 8 we dropped to quarter, or maybe we had an increasing death benefit option B policy for the first 7 years, and then we level it to option A. If it was done in the illustration, you're going to be notified in this platform when to make the policy changes that you had illustrated. We don't automatically do them. That could be terrible for the client if they didn't want to do it yet. Maybe they want to continue to fund. Maybe they decided they still want the death benefit. So any of those automatic changes we're not going to be doing. But we're going to give you the notification and every opportunity to service the policy as effectively as possible. We're going to do an automatic policy review every single year. It's automated. Well, we call it semi-automated because we're going to send a note out to you and say, would you like us to, to generate your annual review now, or would you like us to wait? Now, the reason we do that is since they're so close to policy anniversaries, hand up if you've ever had a client pay their premium on time every single year for the life of a contract. It's almost like an impossibility. So 30 days after a policy anniversary and a client has not paid their premium, we're not going to automatically do the review because the review might look misleading. Like they didn't pay their premium and the numbers might not look great. We'll send out a notice to you and the client that says, hey, it's been 30 days since, your premium was due. Would you like us to run the policy review, assuming no further premiums? Then at 50 days, we send it again just to make sure. What you'll notice is after these notifications get sent out, they're about 10 times better than any premium notice a client's ever gotten in the mail or through an email. Because it's saying, hey, if you want your policy review to be completed, it's time to pay your premium. It generates a ton of follow-up premiums into the contract, which, by the way, you get renewals on, to kind of help move this thing along and do the annual review. We do multi-life administration. So if this isn't just a personally owned scenario, but we do a lot of this kind of stuff for executives that are doing a bonus plan or a SERP plan or a true non-qualified deferred comp. We have a multi-life administration platform baked in here as well. And then the asset aggregation tools. This is available to link to eMoney platform, Broadridge, and Black Diamond. So if you happen to be an RIA or you're doing investments and you have one of these aggregation tools and you want the values in this contract to be part of this overall portfolio, we'll be able to integrate seamlessly to those and kind of make the experience exactly what you're hoping for. To request one of these presentations, this is kind of the roadmap in the future. For now, what I'd like you to do is kind of coordinate with your folks at One Resource Group. They work with me, and we kind of teach you how to fish when it comes to requesting an illustration. So the first couple we'll do on your behalf and kind of be copied along the way. Then eventually you get into a groove where you can go directly to CES. And really it's, who's the illustration going to? Who's the agent? Client name, gender, state, date of birth, rate class. What's their occupation? We do like to know it. How much you get to put in and how much rate of return do you want to assume? And then we fire off a life income plan presentation to you. At this time, Jacob, if we could open it up to any questions, concerns, congratulations, anything that anyone wants to maybe share with the group, I'd be happy to answer.
Absolutely. No, great job. And we do have a few questions here. Actually, we have quite a bit. We'll get to as many as we can. We are running a little short on time, but the first question here says, are there any rider options such as long-term care or chronic illness acceleration?
No long-term care on this contract. This is institutionally priced. We want the cash value to shine. There are no riders that basically can be added to this thing. It is all about the money inside and the accumulated value. So anything that could drag it, we tend to stay away from.
Right.
We do have plenty of contracts that do offer those things and are probably more suitable if those are required for the sale.
Right. Absolutely. Another question here is, who is an ideal prospect for this product? Are there any certain professions you're seeing have a lot of success, or at least opening the door for opportunities?
Small business owners and physicians seem to be kind of the biggest, where do we get people or where are we finding and making these plans for? We actually, in the physicians marketplace, will create not just a life income plan, but a physician's life income plan. This platform was actually built for the AMA back in 2009. They came to us and said, hey, we want something that has, I'll get to this slide really quick. We want this stuff on the right. We want it to be accumulation, look like a deferred comp plan, no surrender charges, fully liquid, all the tax-free benefits, all the investment options. This was their ask list from the AMA. And that's essentially why we built it. Now, the biggest part being, and we want it to be personally owned. That's where most carriers shied away and said, no, we want nothing to do with that. Because we can't risk the amount of people that could surrender or lapse the contract. We don't really have a worry with that. our retention on this contract is like 3 times better than our retail product line. So we're comfortable doing it personally owned. So physicians is huge, but small business owners. This is someone that has a tech business, construction. Think any small and medium-sized business owner in your marketplace. They are the ones that are writing these contracts without a doubt.
Absolutely. We'll answer one more question. We got to hop off here. Some agent is asking, can you clarify on who CES is?
CES stands for Corporate Endowment Solutions. It is a group that was started about 30 years ago. It was an Equitable advisor in Springfield, Illinois, a gentleman by the name of Randy O'Brien. Basically, he was an advisor that specialized in deferred comp and built a TPA platform called CES Administration. 4 years ago, we acquired his business, purchased it, brought it in-house, and paired COIL and his platform to be one packaged offering. So CES is a wholly owned subsidiary of Equitable. When you think CES, think Equitable. When you think Equitable, you think CES. We are all one thing. So it's more like our marketing and administration platform for COIL.
Absolutely, man. Perfect. Well, like I said, running short on time. For those of you that had questions that didn't get answered, your life rep will reach out to you and make sure you're taken care of. But no, John, I appreciate you hopping on, man. Any final remarks you want to leave us with before we hop off?
Nope, no final remarks. I know we're up against time, so I do appreciate that. Thanks, everybody, for showing up.
Absolutely. Thank you, John. Thank you for everybody hopping on. Stay tuned for our webinar next Wednesday at 2 o'clock. It'll be another exciting one. So once again, John, thank you for your time, and thank you for everybody hopping on.